Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
All right, we're back here. Investor Coaching Show, Paul Winkler. Ira work. All right. Well, we talk about money and investing. PaulWinkler.com is the website. Next workshop that's coming up, go sign up for it. A lot of people think that, well, you guys just like, and I've heard financial advisors say this, put that in quotes. Well, they're just indexing guys. That's all those guys are. No, we're anti-gambling, but not indexing as an, if you don't know what an index fund is, well, you're just tracking a certain area of the market. It works well in a couple different areas of the market, but if you look at smaller companies, value companies, international small value, emerging markets, small value, you look at these various areas of the market, it doesn't work terribly well, number one. Number two, what we're finding now is that investment companies, investment advisors, robo portfolios, for example, robotic portfolios, they're using indexes to, instead of just stock pick where they used to move individual stocks around a lot, now what are they doing? They're moving around entire areas of the market through the index. They're just using that to gamble now.
Well, those companies that say that we're just indexing, they've actually never come to any of our education workshops. They actually have no idea what we do.
That's true.
Because if you look at the funds that we work with, they're not index funds.
I did have a financial advisor attend one of my workshops once. It was one of the most awkward things. He was a financial guy, and it was interesting. I actually showed up at a workshop that I was teaching up here in Goodlettsville. But it was fun. I mean, I got along fine with the person. I don't even remember who it was. And I've had people that I've known for years, financial advisors. And now they they're a couple, there aren't many, but they're a couple doing what we do in this area as a result of some of the conversations that I've had with them. So, and I welcome it. I think it's a good idea. Come on, guys. Get with it. The academic research, it's the water's nice. Jump in.
Well, as much as we would like to have everybody in Nashville or, the greater Nashville area investing with us, we're just not big enough to handle everybody that needs our help.
True.
I mean, that's one of the reasons why there's now 7 advisors at this company. You were working all by yourself, and you had said to me, Ira, I have too many people. If I worked 24/7, I couldn't help everybody.
Exactly. That dog wasn't going to hunt. I couldn't do it anymore.
16 years ago, Evan came up here. 15 years ago, a little more than that, I came up here. And, now we're 7 advisors trying to help as many people as we can invest the right way for their financial success.
And then Jim came here from California. Jonathan came here from Chattanooga. Then you had Ann coming up from Wisconsin. Yeah, Arlene was around here already.
But originally she was in Atlanta.
She was in Atlanta. That's true. Yeah, that's true. Good point. So we'll grab them from all over the place. Yeah. I've had some people, some people that have from other financial advisors in this area that come and say, I want to work with you guys. And I always tell them, go get a degree first. First go get a financial planning, go become a chartered financial consultant, certified financial planner. That's your starting point. And then, the academic stuff, if somebody's high quality, you can teach them and get them the rest of the way, and they can learn some of the academic stuff as they go. And because I'm not going to let them go and do whatever they want anyway. Right. All these offices, if you look at the way they operate, it is, you don't have to worry about, do I go to the Murfreesboro office? Am I going to get the same treatment that I get the Goodlettsville office, that I get at the Cool Springs office?
No, but in Murfreesboro, they can get
You think it's going to be better, don't they? Yeah, I know. I knew you were going to say. I was like going, I am walking into a trap
and
here.
In Tullahoma, they get me.
Yeah, I knew. It was like, I knew I was stepping in it.
I mean, I have clients in 10 states. We do Zoom meetings, we do emails. I mean, we can help however the investor wants us to help them.
So according to Devine, the investors parked heavy in cash may be making a mistake. And this is interesting because it was talking about investors sitting on the sidelines in cash. A lot of people have been doing that. They see higher interest rates at the banks. They're going, hey, look, I can get this interest rate at a bank. Let's just do that. And let's just, let's put money over there because the interest rates haven't been this high. Well, inflation hasn't been this high in that long. That's why the interest rates are high. But I thought it was interesting that Nuveen had done this little piece of research on it, and they were looking at different periods of time since we had rate hikes. They said, as you look at a historical return, shows that the broader $55 trillion U.S. bond market typically outperformed short-term treasuries at the end of the past Federal Reserve rate hiking cycle since the 1990s. So they're walking through different periods of time in history when we've had rate hikes and finding that sitting in cash is not such a great idea. And, the same thing is true, though, if you look at equities historically. Now, and this is, we can't predict the future as to when this is going to happen or how it's going to happen. But if you look at history and look when the interest rates have been higher, and right here, what they're doing is they're looking at the bond markets. Because a lot of people have been getting a little bit panicky about bonds because when interest rates go up, the way a bond works, when interest rates go up, bond prices go down if they're longer types of bonds, 3, 5, 10. We don't like going out that far. 6 years is about as far as we'll go out. But what happens when interest rates go up, bond prices can drop down. And what happens is that if that coincides with a market downturn like what happened last year, and you can already see from so far this year that it would have been a mistake to walk away from equities or stocks. But here's the point. A lot of people said, oh, wait a minute, longer bonds and stocks happened to go down last year because of the interest rate increases, causing greater costs to the companies, which drove down earnings, part of what drove down earnings. And then stocks went down and longer bonds went down together. Let's just get out of bonds. Let's just ditch bonds. We don't need bonds anymore. Let's just put it all in cash because cash doesn't go down, as far as like money markets or something like that. Short-term cash doesn't typically go down. I say typically because you can lose value in anything. And, the reality is there's no such thing as absolute safety anywhere. But here's the thing that they're making a mistake on right now is walking away from those bonds and looking back at history is what Nuveen's saying here. If you look back at history, when the Federal Reserve has gotten involved in rate hiking cycles, that you look at the bonds versus cash, and you historically would have been making a huge mistake. Jumping all in cash is their point. Because the reality of it is, this is what people do when they walk away from any investment that does not perform up to what they thought it would perform at. They are basically walking out to the barn and closing the door after the horse has already left. When you walk away from bonds, you're saying, I don't want to be diversified. And you're walking away from diversification, number one. But number two, based on history, you could be walking away from much higher returns during Fed rate hiking cycles, is what they're saying here.
Well, and the interest rates will come back down. So the bonds will actually then increase in value.
Yeah, if interest, exactly what Ira's saying.
Let's just, and I teach this in one of my workshops. Let's say you take $100,000, and this would be a really good example of the fluctuation in interest rates and what happens to bond pricing and why. Mm-hmm. So if you take $100,000, and let's say you get a 7% rate of return, you're going to get a $7,000 a year income. Mm-hmm. Now, if interest rates go up to 9%, if I invest $80,000, I could actually get $7,200 worth of income, a little bit more. Mm-hmm. But I don't have to pay $100,000. So I would not pay somebody $100,000 to buy their bond from them that only pays me 7% when I could buy the brand new bond at 9%
at a lower
and
price.
Keep $20,000 in my savings account.
That's a really interesting way of explaining it. That's really good.
Now, on the flip side of that, if interest rates go from 7% to 5%, I now have to invest $140,000 to get that $7,000 worth of income.
Mm-hmm.
So I might be willing to pay you $135,000 for that 7% bond that you have.
That's right.
To get $7,000 worth of income. It's all going to depend upon how long, what's the maturity, how long can I collect that $7,000 for?
Yeah. That's a fun way of explaining it. That really is. That's good. I like that. You got to put that together in a slide for everybody because I like that. The numbers are all.
That's all you need. It's
That's
just
cool.
the basic.
It is. It's a great way of explaining bonds. Yeah, I never explained it that way, but that's really cool.
And it's what we call an inverse relationship. Interest rates go up, your bond value goes down. Interest rates go down, your bond value goes up. It's very simple.
Paul Winkler, along with Ira Work, understanding that you don't walk away from diversification just because something didn't work out in the most recent period doesn't mean that you walk away from diversification. And so often we do that and we make that mistake. But I thought that was really, really an interesting thing, how they could be making a huge mistake and using a little bit of history. Not that history necessarily will repeat. Paul Winkler, be right back after this. Hey, this is Paul Winkler. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out. So we have 10 offices in the Middle Tennessee area, and everything that we do is fee only. We align our interests with your interests. So you can get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degreed planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon. Okay, back here on the Investor Coaching Show, Paul Winkler along with Mr. Ira Work talking about money and investing and diversification. Do you see, Ira? Speaking of investing, well, not investing mistakes, but financial mistakes, Americans are dropping homeowners insurance, claiming the odds of disaster don't justify the cost. So these would be, of course, people that have their homes paid off and don't necessarily have to have homeowners insurance. But that blew my mind. The Wall Street Journal talking about some skipping insurance, say that they're doing so because they can no longer afford the rising premiums. National average for homeowners insurance based on $250,000 in dwelling coverage increased this year to $1,428 annually. And because people are looking at that going, $1,428, if a $250,000 house burns down, I got that, but I can't afford $1,428. That to me, that blows my mind that people are skipping out on homeowners insurance. They said, and it's not. I didn't even see this till just now, but it's actually wealthier people are doing it as well because they're looking at going that they have saved enough money to rebuild. But the risks of foregoing policy is significant. You're not just talking about fire, your house burning down. You're also talking about wind damage. You're also talking about floods.
Like but you're going
to have
Florida.
but flood insurance. That'll be an exception in a homeowner's policy. So you don't necessarily have flood insurance with a homeowner's insurance policy. You'll have to have the national flood because it hits too many houses at once in one area. So, but you'll have, let's say, theft. somebody breaks in, or somebody you have liability coverage. I would look at. I would look at that as one of the biggest reasons to have homeowners insurance is liability. Somebody gets hurt on your property.
I talk to clients about insurance all the time, and I say, insurance is the only thing that we actually buy that we really hope we never use. Mm-hmm. Now, if you have a $250,000 house and you're trying to save $1,428 a year on the policy, you would have to save that money for 175 years in order to have the $250,000 to build a new house. Mm-hmm. Now, yes, you can take the money out of your investment account, but that's going to then reduce what your future income is going to be.
I've actually, so one of the things that I have talked about is that homeowners insurance, disability insurance, health insurance, auto insurance, all of this stuff is the moat around your castle.
Right.
And that's the analogy that I like. I mean, the metaphor that I like is that you're having something protecting the rest of it.
But the reality is, even if you canceled your homeowners insurance, you're still insuring it. If you don't buy long-term care insurance, you're still insuring it. If you don't buy health insurance, you're still insuring it.
Yeah, it would be
self-insuring.
Be the Winkler Insurance Company.
Right. That's exactly right. So it's not a matter of, well, I'm not paying for insurance. No, what you're saying is, well, if I need it, I'll just lay the money out of my own pocket. So you're ensuring that you're going to take care of it yourself. So you either lay it off and pay pennies on the dollar to have an insurance company take care of it, or you just spend whole dollars, and lots of them.
Mm-hmm. Well, and I think part of it is there are a couple of reasons that I see this happening. Number one, insurance companies, they're dealing with having some bad bond investments of their own. So they're having to raise premiums to cover some losses that they've had on the investment end. Note to somebody that says, I'm going to put all my retirement money with an insurance company. They're not necessarily the best investors in the world. The second thing is some of the unexpected climate issues. People call it climate change, and I would just say that climate's always changing. I remember in the 1970s, of course, it was the ice age that was coming, that was imminent, and there's always differences in climates that go. And some people, I've heard people blame it on all kinds of things. I'm not going to get it. I was going to jump into it, and I was like, no, I'm not going to jump into that, because some of the theories as to why the climate has changed has been fascinating to me. But in essence, you'll have hurricanes coming from unusual places. You'll have tornadoes. The tornado alley seems to have moved. It used to be always that you would see the tornadoes. Think of Dorothy and Wizard of Oz. That was always where all the tornadoes were out there, and now it's Alabama. It seems like I hear a lot about tornadoes down in that particular area. You have good winters, bad winters. You'll have issues with, I'm just thinking about, hailstorms that might come in and take out your roof. And all of a sudden, you got to replace an entire roof. And that is not cheap at all. You'll have a car accident. A lot of times your car and your homeowner's insurance are tied together, and you get discounts for having those two things together. Now, are you paying more for your auto insurance because you don't have homeowners insurance? I mean, think about that. It's that may mitigate that to some extent. Just kind of thinking through this as I'm just kind of thinking on the fly as to what this actually can cause.
Well, I have a separate policy for my wife's my wife's ring. Mm-hmm.
Yeah.
Okay, because
sure.
I use an independent company that is strictly a company that insures jewelry. Mm-hmm. Because if someone broke into the house and just stole her ring, or if she lost her ring and we put a claim in through our homeowners insurance, that's going to raise the rate on my homeowners insurance.
And it may be a schedule on it as well. So a lot of times people have, and if you don't know what a schedule is, if you have collectibles, let's say that you collect guns or
Artwork.
coins or artwork or musical instruments or whatever. You may have a dollar amount that stuff is covered to. Look at your homeowner's insurance policy. It may be only covered to $2,500 or something like that, and you may have $15,000 worth of stuff. You may be taking, like, let's say that you move things in your car, from your home. And, you might have something out, you're driving around town and you're a musician and you have your equipment, and then all of a sudden you're loading up your equipment and somebody decides to unload it for you. Prematurely.
Without your permission.
Yeah, prematurely. Not funny, but let's say that happens and now you're out whatever it is for that equipment.